Hello everyone. So this is Arvind Rao, chartered accountant and a CFP. Into the financial planning profession and tax advisory now for close to 16 years. And basically, the whole objective for me is to help people plan their finances and taxes better. And given this background, this webinar that you are participating in right now is to help you understand the common mistakes in relation to tax planning. So generally we come across learning objectives for a session, but I have tweaked it a bit here to talk about some sharing objectives that I have when it comes to tax planning and the mistakes. So because of what we do in our profession, we usually come across people at different life stages and different situations. And in this journey, we have observed that when it comes to income tax, mistakes that people do in relation to their income tax is more often than not identified only post the transaction is done. In fact, as an advisor, you would have probably come across some of these mistakes in relation to your clients' lives already, and there is also a possibility that many of these mistakes you would have not uh, uh, come across as yet. So the whole objective of this webinar is to orient you in understanding what are the typical mistakes which people do when it comes to handling their taxes, and you will observe that most of these mistakes are also situational. So the idea is to give you a background in relation to a situation so that you could see through, or you could even anticipate in terms of mistakes that your client could do based on mistakes that people have already committed in their lives, which I'm going to share here. And I would like to mention specifically here that when it comes to taxes, definitely a mistake can cost you millions. But what is important here is that any lesson that you can learn from this mistake will definitely help you bring back billions. So with this introduction, let me delve deeper into this topic and take you through some of these most common mistakes. So the first on my list here is an assessee's or a client's failure to pay advance tax. And friends, let's understand that the cost of this mistake for every individual can easily be up to 12% per annum. Let's understand this mistake better. So I'm talking about, let's say, Aarti, who is a salaried individual and has made moderate to substantial investments in bank fixed deposits and also trades regularly in shares. Now, obviously, being a salaried employee, she feels that her tax obligations are taken care of because all the taxes that are due on her salaries have already been deducted by her company. So she feels that as long as she's paying, she's filing her taxes within the due date, she is, doing her bit. But given her second part, which is investments in bank FDs and as well as the trading in shares, she realizes that when she goes to file her returns, she has to pay some additional taxes, and along with this tax liability, she also ends up paying interest for non-payment of advance tax. Now, this becomes as a surprise to many salaried people because they feel that when all of my taxes are being paid by my employer, why am I ending up paying more taxes at the time of filing of returns? So, friends, as advisors, we need to educate our clients that the liability to pay advance tax is on each and every individual, irrespective of whether they are earning salary or whether they are into business. Because the most common misconception that people have is advance tax is for business and business people. No, the liability to pay advance tax arises to every individual who has a liability to pay more than 10,000 by way of taxes at the time of filing their returns. So all people who have income accruing out of fixed deposit interest or bond interest, trading in shares, or let's say even for that matter, any rentals that they earn on their properties, in all these cases, when the income is computed at the time of filing of returns, if it is found that the total tax that they have to pay after giving credit for all the taxes that have been deducted at source, or TDS as they are called, if this amount is more than 10,000, they should have paid advance tax. And if they have defaulted in not paying advance tax, then they end up paying interest at the rate of 1% per month for the year during which they have not paid the advance tax, plus beginning April of the assessment year till the time they don't pay the liability, the 1% per month keeps on accruing. So, friends, as advisors, as financial advisors, you have the in-depth information about the investments that your clients are holding. So if you find a situation where people have fixed deposits, trading in shares, or for that matter, even mutual funds or rental incomes, please educate them to get in touch with their tax consultant, or maybe even you could help them in doing a computation of their advance taxes and helping them pay the installments as prescribed. I move on. Next area where people often err is that they don't seek advice before taking up any out of the ordinary transaction. Now, what am I talking about? Let me get into a situation here. So recently, when we were helping a client file their returns, we observed that his wife's account, that is the bank account statement, showed cash deposits to the tune of approximately 5 lakhs, and his minor son's bank account also showed cash deposits to the tune of close to 10 lakhs. Now, the client, let's call him Manoj, at the point of filing of returns tells us that all this cash deposits is basically on account of inheritance that has come from the grandparents during the year. Now, friends, the problem here is that although the client believes that any inheritance money is not taxable, which is right, the problem that will arise here is that the inheritance is not an issue, but the inheritance being cash deposited into the account is a big issue. Because let me take it a step further here. In case this case is picked up for scrutiny by the tax officer, the first question that the officer is going to ask your client is that I leave it to your discretion to prove to me that your inheritance cash has only been to this extent. Obviously, these being cash transactions, there is not going to be any paper trail available with the client. So the taxman would then like to believe that maybe you actually got sources of cash which is much more than this, and you have ended up depositing only a certain amount out of it into your account, which you are now categorizing as amounts received from grandparents. So friends, here the point I'm trying to make is, please go back to your clients, talk to them that cash deposits are not as looked upon as favorably as a client would like to believe by the tax department. So if there arises any situation in their life where they end up receiving cash, then they should seek advice before such cash is deposited in the banks, so that they understand what are the implications and necessary precautions or steps are taken beforehand, rather than these deposits having been done and at the point of filing of returns, when it is pointed out that these cash deposits could be potentially a source of conflict at the point of assessment, there is very little that can be done, because once the cash is deposited, even if your client goes and withdraws it out from the account, it is of no use, because once deposited, cash is to be regarded as an income. Related to this, I'll narrate to you another situation where one of our clients' father, let's call him Ashish, sold a property in a southern part of India, and part of this agreement value, let me say a substantial part of this agreement value, was actually received in cash. Now, our client's father believed that as long as I'm depositing this entire cash in the bank and I'm declaring that this is what is the entire cash that I have received out of sale of my property, I have very little to worry about, because I am depositing all the cash, right? I am an honest tax paying citizen. I don't mind paying taxes on whatever money I have got as a result of this sale. But believe me, in this case, when the case was picked up for scrutiny, and the officer had only one question: you prove to me that you give me some documents, or you give me a trail that by which you can prove that this is the only cash money that you had received in this deal, which, as you and me know, obviously it is impossible to provide any trail to the officer. And what this implies is the officer is forced to treat the entire cash as unaccounted income, and will lead to serious income tax additions as well as penalty. So, any cash available, please discuss before it finds a way into the client's bank account. Let me take you to the next mistake here. Switching jobs is very common amongst our clients. But if I tell you that one of our clients actually ended up paying close to 1.2 lakhs as tax at the point of filing of returns, merely because she switched jobs, it is difficult to believe it, right? It will obviously be. So the mistake here is not that she switched jobs. The mistake here is that, as typical individuals, whenever you switch a job, you tend to declare all your investment declarations, all your home loan deductions to both the employers. And more often than not, the second employer tends to ignore the salaries that were paid to the individual before or rather in the first job. Unfortunately, when you club both the salaries at the time of filing of return, the benefit of deductions as well as the slab rates are only available to the individual once. So let me show you some screenshots here. So if you check the form 16 of the this individual at the first employer, looked something like this, where the taxable salary is close to 10 odd lakhs, and from that they have taken deductions for the provident fund of around 49,000, and resulting to a net taxable income of close to 10 lakhs 32,000. Thereby, the total tax payable coming to around 1 lakh 25,000. Now, the next screen shows you the form 16 for the next job, where again the income is around 10 lakh 84,000. And here you see that the provident fund deduction has been claimed again, which is 65,000. Now, when I say again, it is basically provident fund for the second job. And the tax thus payable comes to around 1,21,000. Now, friends, you will notice the anomaly here that the next screen shows you the computation sheet for this individual, where the moment you add the salary from company A and company B, the total income jumps to 21,76,000, and the deductions of provident funds put together comes to around 1,15,000, thereby leading to the taxable income touching around 19.5 lakhs. On that, when you calculate the taxes, it comes to close to 4,10,000, and the TDS for both these companies put together comes to a mere 2,88,000, thereby leading to the balance tax payable of 1,20,000 plus interest of close to 11,000, meaning the liability to pay at the time of filing of returns is 1,31,500. Now, this could be a serious cash flow problem, because for people with EMIs and other expenses, 1,31,000 is close to a month's salary for the individual. It is very difficult to bring out these amount and pay these taxes. And to add salt to the wounds here, that without paying these taxes, it is impossible to file the returns. So, friends, the biggest mistake we have to avoid here is, whenever you hear about your client switching jobs, educate them that ask your second company to ensure that they're taking the first employer's salary into account. The tax computation sheet for the second company should clearly show the salary that they have taken for the first employer. Plus, how does the employee validate this? So when you shift jobs, obviously people generally switch for a certain percentage hike in the salary. So the in-hand salary in the second job should not be materially different from the in-hand salary that the person was getting in the first job, because when it tends to be materially different, or rather I should say more than the hike that you bargained for, that's a serious problem, because that will indicate that the second employer is not factoring in the previous salaries, thereby leading to a lower tax and a higher salary in hand. So it can lead to serious cash flow problems in the end. So a more moderate increase in hand salary is what the client should seek, rather than a very high in hand salary. I move on. Getting rental incomes is okay, but this situation, which is, let's say a Gaurav and a Monica are jointly owning a 2 BHK flat in one of the suburbs in Mumbai at Kandivali, and they let out the same, let's say during June 2019. But Gaurav chooses to book the rental agreement only in Monica's name, predominantly because she is a non-working spouse. So the logic behind having the rental agreement executed only under Monica's name is so that Gaurav doesn't end up paying tax on it. Friends, this is grossly wrong, because just having the rental agreement registered in one owner's name doesn't make that income to belong only to that owner. The taxability of rental income straight away follows the ownership pattern of the property. So avoiding to pay tax by having the agreement executed in only one spouse's name is a big mistake. Of course, at the point of filing of returns, this mistake doesn't come to the fore, but in case there is scrutiny or assessments, the officer will insist to see the rental agreement, will insist to see the ownership, property ownership papers to see who are the owners, and at that point, it could be a serious issue for the client, because the officer would then like to make additions in the computation for that spouse who has not offered this income in their returns. A similar situation is that the rental agreement may have been done in both names, but Gaurav gives an instruction to his tenant that 100% of the rent should be paid only in Monica's account. So at the point of filing of returns, Gaurav's intention is that since the total money has come only in his wife, that is Monica's account, it should be only taken as her income. I just wish this could be true. I mean, if it was true, it would have been great. But again, like I said, this is a big error or mistake that your client does, because at the end of the day, the taxability of income follows the ownership pattern. So Gaurav and Monica both are liable to pay tax in equal proportions on this rental income. Even if Gaurav doesn't receive a single rupee in his account, it doesn't matter, right? So moving on, let's talk about businessmen or professionals and their cash withdrawals. Now, a typical situation, let's say a client called Yash has a retail shop, and typically when you have a retail shop, you end up having a current account. All his utility bills, even children's school fees, most of his personal expenses are paid from his business current account. And there are no separate cash withdrawals that they may see in the current account. Uh, Obviously, we understand that people don't withdraw cash because they may be having some income from business or profession that is accruing to them in cash, which they are not disclosing in their returns. Friends, let me help you understand that as their advisor, you need to know that nowadays, whenever business cases are picked up for scrutinies, the first question in the assessment questionnaire is, show us your cash withdrawals during the year. So people in business not withdrawing cash from their accounts is a serious issue, because if you were to tell your tax officer that I have not withdrawn any cash from the account, it becomes a straightforward invitation to look at your case with suspicion. To look at your client's case with suspicion, because it is impossible that you can survive without any cash withdrawal. I understand it's a digital world. A lot of payments can be made, via wallets, via net banking, via credit cards. But we are still not in 100% digital age where it is possible to survive without any cash withdrawals. More so if you are in business, because lack of cash withdrawals gives a hint to the officer that maybe these guys are having cash incomes and they would then want to make some additions to the income, uh, so that to provide for these cash withdrawals. Moving further, salaried individuals who have a home loan, and they declare this home loan to employers, especially when they have rented properties. Friends, the cost of this mistake I am not able to quantify here because it could be quite huge. So let me give you an example here, which will help yourself quantify the mistake. So Chandan, who has been working with an ABC company, has declared that he's having a house property for which he is paying interest close to the extent of 3 lakhs. And he's declared to his employer that the deduction on account of this interest should be taken as a allowance under his salary calculations. And I think most of us know that 2 lakhs is the limit up to which he can get the deduction. So when the salary TDS is being calculated, Chandan is happy because he's getting a deduction for 2 lakhs. And this lowers the TDS that is deductible on his salary. But what he's ignoring is that this flat has been let out and the rent on this flat is close to 10 lakhs. So friends, let's visualize a scenario of what will happen when he files his returns. At the point of filing of returns, 10 lakhs is the income on which he will be getting a standard deduction of 30%, which means 3 lakhs is knocked off, leading to a taxable income of 7 lakhs. And from this 7 lakhs, he shall get interest deduction for 3 lakhs, thereby leaving him with a positive income of 4 lakhs, which is liable to tax. Now, friends, let me help you visualize this scenario that while his salary TDS was calculated, there he showed a 2 lakhs of interest cost, which is a loss under the head house property, which led to lowering his salary income by 2 lakhs. But when he calculates his taxes at the time of filing of returns, the income under the head house property is actually being calculated at 4 lakhs of positive income, which means his journey has moved from 2 lakhs of negative income to 4 lakhs of positive income, which is in essence 6 lakhs of additional income when it comes to his filing of returns. On this 6 lakhs, 30% means straight 1,80,000 of extra tax that the person will end up paying, not to forget the interest that they have to pay, which means 2 lakhs will roughly be the liability that will be incurred by the person at the point of filing of returns. Again, friends, let me remind you that paying such huge amounts at the point of filing of returns really takes a toll on the person's cash flow. And that's why avoiding this mistake or helping your client avoid this mistake is extremely important. So these are the most common mistakes that you will that I wanted to share, which we have encountered in various situations, which can be extremely relevant for you to anticipate when you're looking at client situations. And actually, based on these situations, I'm kind of helping your life make it easier by also giving you some ready takeaway questions that you should pose to your clients when you hear from them about any of these situations. So I'm giving you like the 10 must ask questions to your clients to help them prevent committing these mistakes when they are in these life situations. So if your client informs you that I have moved on to a new job last month, if you hear these words coming out of your client's mouth, or if they have scheduled a meeting with you to discuss what they need to do with the additional salary that will now accrue to them because of a job switch, according to me, these are the 2 questions that you need to pop before them first, which is, have you declared your salary from your ex company to your new employer? Now, friends, I believe the answer that your clients will generally give here is, of course, because whenever you switch jobs, the new employer asks for the salary slips or the salary sheets from the previous employer. So the answer to this question must be yes. But the second question is more important, which your client should be able to answer, saying that, did you see your in-hand salary being substantially higher than your previous in-hand salary? If your client answers this yes, then you have to caution them that this is a red signal. They need to go back and check with their employer about the computation, see for themselves whether they have taken the old salary into account, and only then should they be relieved, because otherwise it could lead to a serious cash flow issue. Second set of questions. Your client announces that he has bought a new property or he is going to buy a new property. First question for you to ask them, have you checked and examined that whether there is a requirement to deduct TDS? I think most of us are aware that as long as someone is purchasing a property which is valued, the agreement value of which is more than 50 lakhs, every buyer has to deduct 1% tax on the amount that they pay to the seller, and this has to be done before they pay off the total amount required to be paid. And there is a separate return procedure that has to be followed for payment of this TDS to the credit of the government. Second question that should be asked is, are you aware that TDS deductions have to be done in the same proportion as the ownership? So if your client is planning to buy this property in joint names with his or her spouse, then they have to ensure that the TDS deductions are also done in the same names, because we have seen that in many cases, especially when it comes to builder owned properties, wherein the individuals are buying property directly from the developers, in which case the developer would say that I will help you discharge your TDS liability, and they would do the filings on their own. But many a times they do the filing in single names rather than joint names. So let your client know that the deductions have to be also done in joint names, likewise as you have declared in the agreement. So these two questions become important here. Third event is where you know and you have seen that your client is holding substantial investments in fixed deposits or bonds or fixed income investments. So to warn them or ask them that, have you seen whether your liability to, whether you are liable to pay advance tax on this interest income? And if you're talking to senior citizens, checking with them that are they aware if they are availing the deduction under section 80 TTB, which gives them deduction up to rupees 50,000 on the interest that they're earning on their savings account and their fixed deposit interest. Friends, this 80 TTB is a new section that has come into effect from assessment year 1920. So it's like a year old as we talk now, and many senior citizens in your clients may not be aware of this. Even if they are, they may not be aware that this deduction is available for FD interest as well. So these two questions to be posed for people, and for senior, I should say two questions for senior citizens, one question for a non-senior citizen, and we have already examined what are the implications for not paying advance tax in time. Yet another situation is where your client informs that they are actively trading in equity shares. So friends, the big question that you need to ask them is to make them aware that profits arising from day trading or high volume trading in equity shares, which may not be day trading but may be trading quite often or quite frequent, but the volume is pretty high, this is liable to be taxed as business income and not as short-term capital gains. Why we need to educate clients here is because short-term capital gains are typically taxed at 15%, whereas depending upon the volume or the quantum of profits, business incomes end up being taxed at the higher slab rates of maybe 30% as well. So this difference in income will not only end up making the client paying higher taxes, but again, advance tax liability also arises here. One, And number two, even if advance tax liabilities are being discharged, paying tax at higher rates, if it is liable to be taxed as business income, will be relevant, because if your client does not discharge their tax liability in this manner, it will end up in them paying higher taxes at the time of filing, which can again become a cash flow issue. Next event is if you see your client informing you of a good news, saying that they have now have their asset, a house which is now given on rent, thereby helping them earn some income out of their investment assets. Now, definitely this is good news, but when you come across this, the two questions that you need to keep in your mind to pop to your client are: one, now that you're earning rent on your property, have you still declared interest on home loan to your employer? So if your client answers yes, then your next feedback to them would be that, you know, that now that you are having a rental income which is going to be taxable, so you should be aware that the interest that you pay on this home loan will be allowed as a deduction against your rental income. And since you're liable to pay tax on the rental income, if you are declaring interest to your employer too, you may end up paying higher taxes at the time of filing of returns. And we have already seen an example in this case earlier in my presentation. So you could probably use the same example by keying in the figures that your client shares with you in relation to the interest and the rental figures to make them aware of how it could lead to a mismatch in the computations, right? Second question that you should ask is that, are you planning to follow the same holding pattern when it comes to your rental income as it is given in the purchase agreement? Like we have seen the examples earlier in the presentation, that people tend to push rental income to be offered only in the spouse's name. So you can educate your clients that in case they're trying to do this, this is one mistake they should definitely avoid, because like I mentioned earlier, at the point of filing of returns, this declaration doesn't, there's nobody who is going to counter the client's declaration that this is only the spouse's income. All this will come to the fore at the point of assessment. And in case of assessment, the officer can go back to the last 6 years and keeping on doing additions in the other spouse's income, which could be really detrimental to the person's cash flow at that point in time. Next life event, your client informs you that he has just bought a sedan or a car worth 18 lakhs. So the question that you need to put, or the information that you need to share with your client here, is that whenever an individual buys a car which is valued at 10 lakhs and above, the dealer is deducting and paying some portion of that amount towards TCS, or tax collected at source. So this TCS is available as a credit to the individual when they're filing their tax returns. So the moment a person has bought a car, you need to just remind them or educate them to tell that, sir or madam, remember that you have paid some TCS on this car purchase. Remember to claim this TCS while you file your returns. So, like for example, if the car is 18 lakhs, the invoice value of the car may be close to 15 lakhs, and the TCS is deducted at almost, if I'm not wrong, at around 1%. So on a 15 lakh car, 15,000 is TCS that would have been deducted and is available as a credit, which can and should be claimed in their returns. Many people ignore this because after the car transaction is done, the dealer really doesn't come forward to give the certificate for the TCS, because nowadays this gets populated in the form 26AS. So As long as your client is able to remember this and claiming it in the returns, but it's in their interest. Next event, maybe based on your advice or maybe not based on your advice, your client tells you that he has surrendered his a unit-linked insurance plan much before the lock-in period of 5 years. In that case, you need to remind them that this surrender value, whatever surrender value is determined by the insurance company, this is taxable. And the irony of the situation is the surrender value is taxable at the point of in the year in which the policy is surrendered, although the money is only received by the investor after the end of 5 years, that is when the lock-in period expires, but the amount is taxable in the year in which the policy is surrendered. So again, normally people tend to believe that anything, when it comes to insurance, any money that is relevant to the surrender is taxable, is tax free. So we need to educate them that surrender value is not only taxable, one, number two, it is taxable in the year in which the policy is surrendered, although the money is received at the end of the lock-in period. Next, during your conversations with clients, you may come across situations where the client informs you that they have transferred money to their kids' account, and from there they are making fixed deposits in the children's name, typically minor children's name, so that it is more tax efficient. Friends, this is a big misconception, misnomer. Any interest that the person earns in his minor's name technically is liable to be taxed in the hands of the individual. There is a provision under income tax called clubbing of income, which mandates that any income that a minor earns because of funds transferred in the minor's name will be taxed in the parent's hands at the rates applicable to the parent. So unless the client is really keen to have some fixed deposits or account in the name of the minor, just so that there is some capital getting built in, it's a good idea. But if the purpose is to save tax by not keeping FD in their name but parking it in the minor's name, it really doesn't help the case, because that income will ultimately be taxed in the hands of the parent. Moving on, you hear your client talking about that they have again purchased a property and got it registered. So sometime back, I spoke to you about making the client aware of the TDS provisions. There is something else that we should remind the client, is that the year in which they purchase the property and pay the stamp duty and registration fee, both the stamp duty and registration fee that is paid in the year of deduction is, in the year of registration, is available as a deduction under section 80C for that year. So if I'm purchasing a property now and I am paying some stamp duty, in this year, the returns that I'm filing for this year, I will be allowed to claim the entire amount of the stamp duty and registration fee under my section 80C savings, of course, subject to a limit of 1.5 lakh. Friends, remember, many people are not aware of this, and for people who generally plan their tax savings year-on-year basis, whose quota of 1,50,000 is not readily met by other instruments, this is a good thing to point out to them, because without incurring any additional outflow, this is something that will help them to take benefit out of expenses that they have already incurred. So it is really, because generally in years when people purchase property, depending upon their cash flow position, a lot of money goes out and people generally are cash strapped in that particular year. So this is a big bonus that they don't have to do any additional tax savings. The stamp duty and registration fee straight away is available to them as a deduction. So it's a real bonus point. Moving on, your client tells you that their property has now gone under redevelopment, and they would now be getting a compensation rent from the builder per month for the time the building stays under redevelopment. So you here what what I want to share with you is that the first question you should be asking is that your client should be aware that rent received from redevelopment of property is taxable only to the extent it lies unutilized for paying rent towards an alternate accommodation. So the point I'm trying to make here is that if I'm receiving rent from if I'm receiving rent from an employer, from a developer for redevelopment, let's say to the extent of 50,000, and either maybe because I'm having an alternate accommodation of my own, I don't pay any rent, or I'm paying rent which is lesser than the rent that I'm receiving from the developer. Whatever is the balance rent, that amount is liable to tax. Many people believe that redevelopment rent being a compensation rent, the same is not taxable. That isn't the case. And slowly and steadily, people have people have begun to start getting notices specifically saying that the department has information that they have been getting compensation from builders. So whether the same has been offered to rent or no is what they need to check. So this is the question that we need to ask to people who talk to you about redevelopments. Friends, these were the 10 questions of the various situations that arise most commonly in our client lives and situations. I'm sure some of these you must have already come across. And there may be situations where people have spoken to you about these situations during in the last maybe few conversations, and you must have realized today that some of these questions you have not posed to them. So I encourage you and urge you to take this opportunity that after this webinar you should go back to these people and put forward these questions so that you help them in anticipating and help them in that tax planning much before than at the end of the year when they approach for the tax. I really hope these live experiences and situations that I've shared here are of help to you, and it helps you to strike meaningful conversations with your clients and help them avoid grave errors right at the beginning when these situations occur than trying to do a post-mortem at the time of filing of returns. Thank you very much for attending and listening to this webinar, and I'd like to end my webinar right here. Thank you.